Welcome to Mortgage Mondays, where we have got a news and legal update for you all. More information is coming out about legislation proposed to limit real estate investors from buying properties by adding even more taxes onto an already taxed database. Christian and I are going to be breaking this down for you, including some inconsistencies in the messages and straight up inaccuracies in what people are being told to get these laws passed, as well as what you can do to start buying properties before that happens by putting less money down and getting better interest rates. All that and more on today's episode of Mortgage Monday. Christian Batchelder, welcome to Mortgage Mondays. How are you this Monday?
I'm doing pretty good, David Green.
All right, we previously did an episode where we talked about legislation in the works to stop real estate investors from buying more properties. The reason being given is that Wall Street and institutional investors are buying up all of the real estate, and so we have to slow them down. And the proposed solution is going to get real estate investors like us caught in the crossfire, the mom and pop investors who are just trying to build up a portfolio for retirement.
But before we get into that, David, the dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. But with Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the entire U.S., they know a thing or two about how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a hospitality-driven booking platform, and around-the-clock support, Vacasa earns homeowners an average of 20% more revenue from their vacation homes. Vacasa is always thinking of ways to simplify the vacation home owning experience by putting your home to work for you. If you're looking to make more from your vacation home, work with a reliable property manager, and finally have peace of mind, partner with Vacasa at vacasa.com/BiggerPockets. That's vacasa.com/BiggerPockets. And now, back to Mortgage Mondays.
So basically, if we break down the argument that Congress is giving us, it's that Wall Street is buying a disproportionate amount of houses. In fact, what they're buying has skyrocketed, and it has increased about fivefold. But here's the problem. It's gone from about 0.5% to 2.5% of the houses that are being bought in the country are being bought from these institutional investors. So even though they've bought 5 times as many properties as they were in the past, it still represents a very small proportionate amount of the total houses that are being sold. And if you look at the total houses that are owned in the country, out of 20 million single family rentals, only about 450,000 of them are owned by large scale landlords, which institutional investors would classify as. So that's about 2.25% of all single family rentals are owned by institutional investors. Now, let me just come right out and say, I'm not a huge fan of institutional investors. I'd be happy if they were not buying houses and more of the BiggerPockets audience was out there scooping them up with us. However, we do kind of have to deal with this, but it's very misleading that we're claiming that all of the housing inventory is being bought up by institutional investors. I do think us as real estate investors are having to fight over the properties we want with institutional investors at a large scale. Right? The stuff that's best for a rental property, yeah. Investors are competing with each other. And we're kind of like, a little guy running around with a machine gun and they're Godzilla. It's not really a fair fight. But when you look at the entire housing inventory, they may be Godzilla, but it's not the sun. Okay? It's like completely different to try to compare here. The percentage of homes being bought by all investors has actually been decreasing from 2013 to the end of 2020. So it used to be about 29% of homes were bought by investors. We're now hovering about 20.5%. So even though we see that there's a lot of investors that are trying to buy properties, the percentage of overall homes that are bought by investors is going down, which means more primary residence buyers are taking place. But the fear is that the legislation that they're putting out there to try to stop institutional investors is going to affect real estate investors like us. Because if you get to more than 15 homes, they want to start adding on taxes. So when you hear this, Christian, you're a property owner, you invest in real estate as well as helping other people to do so by financing it. What are some thoughts that go through your mind?
This is something that I've really tried to stew over in my brain a lot, because if I was the U.S. government, right, if I was the legislative branch, how do I differentiate these institutional, quote unquote, Wall Street buyers from BiggerPockets buyers, right? Like myself and yourself, David, I mean, we're investors, right? Most people on BiggerPockets either are or are looking to become investors, and punishing people trying to grow and build wealth through real estate to try to kill this 2% of house purchases in the country, it doesn't really make sense to me. It seems like you're kind of, you need to change a doorknob, so you're tearing down the whole door. It's like, how about we just focus on, is there a way to differentiate them and really focus on? And from our perspective, from the buyer's perspective who are competing with these, I start to think, what are the loan products? What are the tactics? What are the tools where we can maybe utilize, we can't go get the 2% rates that they can to borrow money because we don't have $1 trillion. But are there some negotiation tools? Are there some tactics that can maybe put the benefit back in our favor, right? Give us a little bit of operational advantage compared to the Wall Street buyers, right? Where we can still receive the benefit from investing and growing our wealth through real estate, but maybe we're also using different loan products and we have some capabilities that they don't.
All right. So that's a great point there. If we're trying to compete against Wall Street here, and we know that taxes might be coming, one thing that I think about is if they're going to tax me more for every property that I have past 15, I want less properties, but better properties. Also, one of the things I've been talking about for a long time, ever since cash flow kind of dried up, is like, hey, if it's hard to get cash flow, let's compensate for that by buying in better locations where we can expect to get better returns over the long term, not just in appreciation, though that is included, but also in rising rents that will ultimately become cash flow over the long term. So if I'm going to be buying less properties, but I want to be buying better properties, that means the locations that I'm going to be buying in need to be appreciating more, which means that there's probably going to be more wealth, which means people are probably going to be vacationing there. That's where I had this light bulb go off in my mind. If I'm going to be buying properties in these types of areas where people vacation, might I buy vacation properties? And do we have a loan specifically for people looking to do that?
Yeah, we do. And this is one of the first things that my mind jumped to in terms of loan products that we could use to potentially compete, right? For a normal buyer, 25% down payments, which is, the starting point for a lot of investment property loans. That's tough. Especially if you're buying in nice areas, vacation-like areas, the Smoky Mountains, the coast of Florida, Gulf Shores in Alabama, places in Texas. It's tough. 20% down is $100,000+, right? It's difficult for the average American to save that up. But a vacation home or a second home loan, David, like you're referencing, is absolutely one of the products that we can use to compete. It only requires a 10% down. So now you're cutting your down payment in half. It's still more than a primary, right? So if you're done buying primaries and you don't want to move anymore and you're stabilized with your family, that's always going to be the lowest down payment. But there is a gap that a lot of people forget that exists between a primary residence and an investment property. And the down payment is right in between 5 and 20%. It's right at 10. And it sometimes allows that door to be opened a little earlier, right? In your investment or your financial journey is in your adult career, whatever you do for work, where you don't have to double that down payment. You can get in with 10% on that second or third property in a nice market that may appreciate.
Right. So it allows you to get into more expensive markets without having to come up with a full 20% down. This is half of that much money, which means you can buy twice as much real estate and still be able to borrow the funds. So if you're not looking at a vacation property or a second home, definitely something I think people should be looking into. For some reason, we just don't talk about this product nearly as much as the primary residence or the investment property loan. Now, we're also assuming investment property loans are at 20%, but we're seeing some of those that creep into the 25 to 30% some of the time, right?
Absolutely, 100%. And that makes it even harder, right? If you guys are setting 20% to be that break even, well, the loan product may not be there for you, right? Like David is saying, we're seeing some slip to 25%, some slip to 30%, especially in the commercial space. That's where you're really starting to get low leverage, right? So you're starting to see 65 and 60% loan to value. And that's now you're bringing in, what's 40% of your purchase price? It's a massive down payment, right? If you're getting any property that's worth really anything in America, 40% is the, a huge percentage of it. So these products that still allow you, obviously the primary residence, the second home, these are how you can stretch your money and really get the biggest bang for your buck in terms of the leverage you can get on a property.
Now, one of the things the article discusses is that there are not enough homes to go around, and that's why we're trying to stop investors from buying more of them. I wish that they would just look at the obvious answer, which is we need to build more homes. We need to incentivize home building, and they can do that through tax credits. They can do it through breaks for if you employ people to build homes. The government can get involved in this if they wanted to build more homes, which would be the smartest thing. Now, maybe at some point they do that, and they say, hey, we need to build more homes. I still hold out hope that we will make the common sense approach, which is to increase the supply as opposed to just add taxes. Let's make it harder for people to buy. If that does happen and they build more homes, the thing you got to understand is that they cannot build them in every single location. Some areas are bought out. In fact, if you think about where they build real estate, they build in the best areas first. So when they build new homes, inherently, architecturally, they can only build in areas that are inferior to stuff that's already been built. Just think about every time that you think of a new home subdivision going in somewhere, it's always what we say on the outskirts. It's further away. It's an area that has not yet been developed. The best stuff, the stuff that's right on the water, the stuff that has the best views, the stuff that's closest to the freeway, the stuff that's in the best weather or the cleanest area has already been built. So what I'm saying is that we should be buying houses there. If you're worried about supply going up, as a response to this affordability crunch we're having. Buy the real estate that already exists in the better areas and just delay gratification. Your investment will be safer and it will also be more profitable. Now, something else that we haven't discussed from the mortgage side, tools you can use to combat this, is when I talk about buying a house a year, it's not sexy. Nobody watches it. Doesn't look all that great, but it's still effective. It still works, right? And that's just to buy a primary residence every single year. You can do that for 5% down. You could do it for 3.5% down. You could do it for 3% down, depending on the loan product that you get. But you put a very low down payment on a house, you buy it in the best location that you could get your hands on, and you hold it for a long period of time. If you want to decrease the housing expense of holding that property, you put tenants in there. It's not as comfortable, I know. But if you're willing to be uncomfortable now, you will be very comfortable later when that grade A property or grade B property that you bought appreciates to a large degree in the best locations, especially if you someday get limited to how many you could buy. Again, if they're going to limit how much real estate you buy, you don't want to have 50 mediocre properties. You want to have 10 stellar properties. You'd rather have $20 million worth of real estate over 10 properties or 20 properties instead of over 150 properties that are a big headache to manage. So just something to think about here, as there's pretty significant developments that are happening in our country when it comes to housing supply and housing affordability. Now, the last thing is, if we saw interest rates go down, we would see affordability go up, but that's somewhat misleading because usually when rates go down, you get bidding wars for houses, the prices go higher, and they don't actually become more affordable. Christian, what are some advice that you have for people who want to get a lower interest rate, but they don't want to wait for rates themselves to come down because that's going to create more competition for the homes?
First and foremost, like you said, David, the primary residence loan is the lowest interest rate on the market. Obviously, it's still where the market is, but it is on the lower end of what is available. On top of that, using seller credits, we talk about this a lot on Mortgage Mondays. It is by far and away my favorite strategy to structure your purchase deals. I mean, I even think back to in the crazy times, 2020 and 2021. I remember I wrote 100 offers in, I think, a 3-month time span because I cared so much about getting seller credit. I wouldn't accept an offer, didn't have seller credit, because even when rates were low then, I wanted to get them lower, right? I was using that seller credit to buy it down even further, right? I think of our temporary buy down products. Obviously, that I would recommend a consultation with your loan officer, but there are temporary products where, you don't get the first year rate. There's like a 2-1 buy down, for instance, right? Where if the rate is 8% today, you'd actually get a 6% the first year, then a 7, then an 8. We have an episode on that a little while back, but those are really good ways to combat it, at least temporarily, while the perspective, maybe 2-3 years down the line, there's a really good refinance opportunity to get out of these 7 and 8% back into 4 and 5s.
But you still get the lower price that you paid for the home when there was less competition for it. Great point there.
That's absolutely right.
All right. Let us know in the comments. What do you think? Are you concerned about Wall Street buying up homes? Do you think that we need to build more supply? And is this new legislation concerning to you that's going to make you pay extra taxes if you buy more properties? Remember, there's nothing that says it stops at 15. Maybe it starts at 15, then it becomes 10, then it becomes 5. Then if you want to own a home at all, you're going to be taxed. Is this concerning to you? And let us know in the comments what your plans are to deal with it. Christian, if people want to reach out to you to get more information about some of the loan products that we talked about, or what loan product or location would be best for them, how can they find you?
Absolutely, guys. We offer all of these loan products we discuss on this show, obviously. If you're wanting to reach out to me, on Instagram is the best place to find me, at The One Broker. And at our website, as always, theonebrokerage.com.
And you can find me at davidgreen24.com, or you could DM me at your favorite social media, Facebook, Instagram, Twitter, wherever. LinkedIn even, at davidgreen24. And as always, the information we got from today came from a BiggerPockets blog article wrote by Andrew Sirius. And you can check that out going to the BiggerPockets website. Tons of resources on there for you, from blog articles to forums to tools to find people like Christian and I, to books that have been written for you, free webinars, podcasts, all kinds of good stuff. So go check us out there and see what we can do to help you build your wealth. If you've got a minute, check out another BiggerPockets Mortgage Monday episode. And if not, we'll see you next week on Mortgage Mondays.